ये क्या हाल बना रखा है?
इंजीनियरिंग तो पढ़ ली लेकिन प्रैक्टिकल नहीं सीखे। करता कुछ हूँ, होता कुछ और है। भाई इस बार ना मेरा फेल होना पक्का है।
ऐसी पढ़ाई का क्या मतलब जिसमें हो नो प्रैक्टिकल्स? चुपचाप जाओ इंटर्नशाला ट्रेनिंग्स पे। यहाँ है 3D प्रिंटिंग, रियल एसआई, वेब एंड ऐप डेवलपमेंट, प्रैक्टिकल लर्निंग वाली ट्रेनिंग्स। ट्रेनिंग सेलेक्ट करो और थ्योरी के साथ प्रैक्टिकल भी सीखो। इंटर्नशाला ट्रेनिंग्स, शुरुआत यहीं से।
Good afternoon, everyone. I'm Umang, and I hope that you're having a great learning experience with us. On this occasion of World Youth Skills Day, we are here with yet another interesting practical workshop for you. Did you know that 500,000 people in India and more than 10 million people worldwide are stock traders? You know why there is such a craze in stock trading and investing? And why more and more people want to learn these skills? The answer is simple. It's one of the best ways of making and multiplying your money. And over that, it's a way forward towards financial independence. Now, there might be hundreds of questions in your mind as to how can I become a trader? How much money do I need? How do I make a shruat in stock market? And so on. So, to take you through a journey from pocket money to a powerful investment portfolio, we present to you this exciting hour with one of the top gurus of India, Dr. Abhijeet Birari. He has a passionate trader. He's a passionate trader and trainer in the stock market for over a decade. He has a Ph.D. in the derivatives market and an MBA in finance. He's an author, analyst, influencer, top B school professor, and even a coach to 2,000 students in finance and stock market. This 1 hour with him is going to give you a head start with your trading career, as he'll be demonstrating live trading on today's market. He will also teach you how to make an effective day trading strategy that you can use to grow your portfolio. I hope you learn immensely from him. So, without further ado, let's welcome Abhijit.
Thank you, Umang. Thanks for the introduction. Since we have limited time, let me straight away come to the point. At the end of this session, what you'll be able to do, what you'll be learning, you'll be able to grab the recipe for success in intraday trading. So we'll be discussing intraday trading in today's session. So you'll be able to know as to what it takes to become intraday trader, successful intraday trader. Then you'll also be able to formulate a robust intraday trading strategy, okay, which can help you to generate consistent profits. And at the same time, you'll be able to calculate risk and reward on each trade. And when you do that, you automatically become confident to trade in the market, and you will be able to do it with an ease once you do that. So, without again much delay, let's start with a quick poll. So, you might have heard about intraday trading, trading in stock market, etc. So, when I talk about intraday trading, what is the reasonable return on investment that you can expect in intraday trading per annum? So, this is the question for you, which you can answer. And Umang, just let me know when poll is finished. Then I will go further. Keshav, once it is finished, just let me know. Keshav, can we go ahead? Well, I guess everybody must have some or the other answer in your mind. So yeah, let's decipher these percentages for you. So when we talk about intraday trading, people normally have very unreasonable return on investment target when they enter. They want 10%, 15% return in a month. So let me just drill down to some figures for you. Suppose you start with 1 lakh and you grow 1 lakh for next 20 years. How much amount you will have at a specific percentage? If you grow at 6%, you'll have almost 3.21 lakh. At 10%, 6.73 lakh. 20% and 30%. 30% you can just imagine 1.91 crore is what you will be having. At 40 crore, 8 crore, and now it will grow exponentially at 50%. If you grow 1 lakh at 50% every year for next 20 years, you will have 33 crore at the end of 20th year. At 60%, 120 crore, 80%, almost 1300 crore, and at 100%, whopping 10,500 crore. So this is the mathematics for you. And if your answer is 200%, then I mean you can just see the figure. So see, it's not about how much return you earn. It's about how consistently you earn that. So even if you make 30 or 40% consistently in market, you will be able to create a tremendous wealth for you just by starting at 1 lakh as an investment. So these are the things that you should keep in mind when you trade in market. You should not have unreasonable expectation. Anything between 30 to 40% is extremely good. One of the best investors in the world, Warren Buffett, has compound annual growth rate of 20%, and many big hedge funds have 20 to 30%. Now this is the pyramid of survival rate of traders. So if you see, people start with get rich quick scheme, and then at the end of 1 month only 40% of them they remain, and 2 years and 7 years, and in a long run only 1% of the traders they make money in market. So that means it's not impossible to make money, to make consistent money in the market. You can do that provided you know the exact strategy to achieve that. And that is what we are going to learn in today's session. So now we will be learning something that will you know that will place you in that top 1% ladder. So if you are ready to learn, let's go ahead. Before moving, this is a disclaimer. We'll be discussing a strategy and few stocks in today's session. They are just for educational purpose. Now, before you trade on any strategy or any stock, you should do your own due diligence. Now, again, talking about failure in trading. So these are the typical reasons. First is they don't have strategy. They don't know. They don't have rules of entry, exit, position sizing, etc. When they don't have strategy, there is no consistency in following the strategy. They will follow one strategy. After two, three losses, they'll jump to another strategy and so on. And why they do that, why they hop between one strategy to another, is because they don't have data regarding how profitable it is, what is the risk, what is the probability that you will make money. In absence of that, you will not remain confident and you will switch between one or many strategies. So that is not at all good for your wealth. Okay. And again, wrong position sizing and risk management. So all these things lead to losses and failure. And in today's session, I will build a groundwork for you so that you can you know work along these lines, and you can also make your consistent profitable strategy that is capable of making consistent money for you. So the recipe for success in trading is this. There is no other way than these four steps. First is you must have a strategy. That strategy should be back tested. That means you should back test that strategy in past, past 2 years, 3 years. You should see that if you had implemented that strategy, how much money would you have made. Then you must consistently follow that, especially when things are going bad. And then at the same time, you have to do risk management. That means you should not take too much risk that will that will wipe out your profits. So these are the four things. If you take care of these four things, you are going to make money in the market. I've been doing it since last 10 to 12 years, and I'm sure that you also will be able to do it. Okay. So the first thing before trading in market is the strategy, as I'm telling you. Okay, without strategy, you should not at all, think of even putting one trade in the market. So the first thing is strategy. You must have a strategy. And what do we mean by strategy? Strategy is nothing but rules of entry, exit, position sizing. Okay, so basically you have created clear-cut rules of how you will enter in the market, how will you take the position, how many shares will you buy, how much risk will you take, when you will take loss, when you will take profit. If you have that, then the trades become mechanical and emotions don't come into the picture. So emotions are your biggest friend as well as enemy in the market. So you have to make your emotions friend, and if you make them friends, then they will, it will help you to make a lot of money in the market. So that is the thing. And if you don't have strategy, then all these things will happen, which I've been discussing since last 5 minutes. So trades will not be automatic. When you don't have strategy, there will be no rule of entry, exit, stop loss. So you will enter when your discretion says, when your logic says that is not the correct approach. There is no backtesting. If you don't have strategy, how can you backtest? And how can you gain the confidence? So all these things and psychology will come into play. Greed, fear, all these emotions, poor risk management. So all these things lead to stress. And the purpose of trading is to make consistent money and become stress free. If you are trading and it is creating stress for you, then that I mean, we are not going in correct path. So when we talk about strategy, a good strategy should answer these questions. So whenever you make strategy, if your strategy answers these questions, that means that you have made a good strategy. What are those questions? First is what to buy or sell. Now there are so many assets and so many areas wherein you can buy and sell. You have a currency, you have equity, you have derivatives, you have commodities. So many things are there. You have blue chips, those small cap companies are there. You have companies that are in indices, etc. So what you will buy, that you have to answer. How many days will you hold the position? Is it an intraday? Will you hold it for a week, for a month? What you will have to define it beforehand. What is the time frame that you will analyze? So most of them will use technical analysis. So you'll use daily chart to analyze, or 5-minute chart, 10-minute chart, 15-minute chart. What is the time frame that you will analyze? You must answer these questions. And comes important question is how much to buy or sell. If you have money to buy 1,000 shares, will you buy 1,000 shares? And if you buy that, how much risk will you be taking? That you have to answer. When to enter the position, this is again very crucial. What are your entry setups? Okay, what will trigger your entry point in the position? Okay, and most importantly, how will you get out of a losing position? This is where you have to accept that you also can lose money in the market. No trader makes money every day. Okay, so it's all about probabilities. Maybe out of 100 you will win 60% times, 40% you will lose. But when you lose, when will you get out of that losing position? You cannot just hold on to the losing position forever. Yes or no? And again, importantly, when will you get out of a winning position? Because exit is what makes money for you. Exit is more important than entry. This is what you have to understand. How will you buy or sell? So there are various tactics of buying and selling. Buying at market price, or maybe trigger price, stop loss order. There are many ways of doing that. I have a strategy wherein I put order after the market is over. So that's an AMO order. So there are various ways and means of entering in the market. So how to buy or sell? There is something called as pyramiding. So there are many things that you can explore whenever you create your own strategy. So these are the questions. These are the questions which you need to answer before making the strategy. Okay. Now we will slowly move towards the one intraday strategy that I have designed specially for this session. So I'll be discussing that strategy, and through that strategy, you will understand how a strategy starts with a logic, and how I build that strategy, and I'll also show you on live market how it is to be done. So every strategy starts with a logic. So without logic, or without, there is term called as assumption or hypothesis, you cannot start any strategy. What do you mean by logic, or what do you mean by assumption? Logic is nothing but conclusion about the market based on experience, observation, and analysis. So you have been trading in market since many days, so you have observed few things, you have analyzed few things, and you come out with a logic. That logic is used to build the strategy. I'll give you some example of a logic. So this one, fall in market is faster than rise in the market. So I'm sure that many of you will agree with me. So when market falls, it falls much faster as compared to when it rises. So this is an observation of mine. So this is a logic. So on the basis of this logic, I can create some strategy. Another is in long run market goes up. So that is again we have seen. You take graph of 20, 30 years. In long run, you will see that market goes up. In short run, it fluctuates. Now this is the observation that I have made. On the basis of this observation, I can make some strategy. Then large cap stocks are less volatile than small cap stocks. Okay, large cap stocks are those stocks whose market capitalization is more than 20,000 crore, and small caps are those whose market cap is less than 5,000 crore. So this is again an observation that I have through my own experiences. Now these are the observations, these are some analysis that I will use to create the strategy. Now in today's class, I have made a strategy. I will tell you what was the logic behind that particular strategy. But before that, if you may be new in the market or you may not have, created any strategy till now, so to start with, how can you form your own logic? From where you can start. One thing that you can do is observe the market. Okay, so observation can give you a lot of insights into market, and through observation, you can build your logic. And the best thing is this, start trading. Even if you start trading with 5,000 rupees, start it, because through experience, what you will learn will be precious. So start trading and you will automatically build logic. You will automatically start observing few factors that will help you to build the logic. And read the books. Okay, I'll recommend this book to you, 100 Stock Market Observations. Okay, written by Barry Schwartz. So here he has given 100 simple observations from trading in the market that he has traded in the market since last 20 years. So you can take one or two observations from this book and start building your own strategy on the basis of that observation. Or there are so many analysts that you can listen on television, or maybe in newspaper also you can read some analysts. So through their insights you can also build the logic. So the first step is to start with the logic, and I'm going to start this equity intraday strategy. I'm going to reveal in today's class. That also starts with the logic. But before that, let's have a quick poll, right? So when we talk about intraday trading, so like, what is your understanding? Intraday trading requires huge capital. It is risky. It requires to sit in front of the screen. Fourth is all of the above. Fifth is none of the above. Okay. So let me give you some time for you to think and uh, go through these options and try to answer them. Okay. So just let me know when it is poll is completed, so that I can proceed.
Yeah, I'll let you answer.
Sorry,
So
ma'am. Can
people
you
are
repeat?
answering between 3, 4, and 5.
Okay, that's good. That's good. Thank you. Thanks for the insight, ma'am. So yeah, many of you, I've got observation. I've got the insight that many of you are answering three, four, or five. So let's start with first option. Requires huge capital. So if you ask me, it does not require huge capital. I have few strategies, intraday strategies, which require only 10,000 capital. Okay, so first thing is it does not require huge capital. Second, intraday trading is risky. The answer is yes as well as no. Why? Because yes, it is risky in the sense that if you do reckless trading, if you don't do proper risk management, then it can wipe out your money. But yes, if you learn, to manage the risk, do risk management properly, position sizing properly, then it is not risky at all. I mean, I have few strategies which are so safe. I mean, safer than the any investment that you will make. So intraday trading is not risky at all if you know how to manage it. Third thing, many of you are maybe answering, that requires you to sit in front of the screen. Again, I'm going to show you one strategy today which does not require to sit in front of the screen for the whole day. It just requires you, like, say, 10 minutes of your time for analysis and entering the trades. So it is not necessary ki you must be there in front of the screen the whole day, and that is not the case. So the answer is none of the above. It does not require these things. Okay. So let's start with the strategy. So my logic of this strategy is, this is what I have observed through my observation in through my experience in last 10 to 12 years. My logic says that when market opens green means when market opens high. So suppose last day it closed at say 16,000, and today it opens at 16,050. That is, it opens green, 50 points up. When this happens, it continues to goes up. Okay, so there is a high probability that it will go up and close up at the end of the day. Vice versa, if market opens red, that is, if market opens down as compared to previous day, I have observed that it keeps on falling and closes, in red only. So this is my logic, or you can say this is my observation that I have made in the market. Now I will use this logic to build the strategy. Okay. So what is the strategy? Let's see. And now next 20 minutes or so, 20 to 25 minutes, I'll be showing you the strategy, you know, on a step-by-step guide to follow the strategy, and then you will understand and appreciate how logical it is, and how systematic you can work in the market as far as intraday trading is concerned. So what is this strategy? This is an intraday strategy. When you talk about intraday, it's basically entering and exiting the trade on the same day, right? So this strategy is, you can say, 9:25 a.m. strategy also. You can call it. So what you have to do basically at 9:25 a.m. you have to go to this link that I have given. So this is nothing but NSE India market live market indices link. So you have to go to that link. I will show you how to do that. But first, let me complete two steps, and then I will show you on live market how it is to be done. So the first thing that you have to do is go to this particular link, and you have to note the change in Nifty 50 index. So Nifty 50 is nothing but index of 50 top companies in India. So you have to note whether the change is positive or negative. Either it will be positive or it will be negative. In rarest of the cases, it will be like neutral. It will be like 1 in 100, you will find that it's neutral, but either it will be positive or it will be negative. So if it is positive, what our logic says? Our logic says that if it is positive, market will continue to go higher and close higher. If it is negative, what our logic says, it will, continue to go down and close in the red. So, so sorry. So the first thing that we have to note is this. Okay. Second is, there is another index called as Nifty 200. Nifty 200 is an index wherein we have top 100 companies, uh, large cap companies in India, and then 100 mid cap companies in India. Okay, so combination of these two is Nifty 200 index. Now let me show you for these first two steps, and then I will show you what analysis is to be done. Okay. So this is the link that I showed you. I'm sure just somebody can confirm that the screen is visible or not. The screen is visible.
Yes, Abhijit, it's visible. You can continue.
Yeah, thank you. So basically, this is the link that I gave. Okay, although now time is 2:23, but you have to do it at 9:25. Why 9:25? Because 9:15 market opens. Initial 5 to 10 minutes they are very volatile, because many people have taken position one day prior. They want to cover those positions, so therefore that way there is a lot of volatility in the market. So first 10 minutes we can ignore. 9:25 we open. Now you can observe Nifty 50 here. Nifty 50, its percentage change is green. Green means it's up. Okay, so when it is up, that is what we have noted, that market opened positive, and our logic says that if it opens positive, it will continue to go up. So this is one point that we have to note, that market opened positive. Now what we have to do is basically you have to go to this Nifty 200. You can see here. Normally you will find that if Nifty 50 opens higher, other will most of them will open higher only. So Nifty 200 you have to go, and what basically it will do is it will populate the list of all the 200 stocks in Nifty 200. uh, this you can just scroll and see. That is not important to us here. What we have to basically do is we have to download this CSV. This is nothing but an Excel file that you'll have to download. So what information will it give? It will give information about this stock regarding open, high, low, close, last traded price, percentage in change, etc. So this is a crucial information for us that we will require. So what I have done at 9:25, I had downloaded this file here that I will show you. Wait a second. Yeah, I'll just hide this other columns for you. And yes, so at 9:25 you have to download this file and open it. You can just see there are 200 stocks here whose information is available to us, like open, high, low, previous close, like this is previous day's close, LTPs is last traded price, change, percentage change, etc. Okay, so 23 rupees, say it has changed, but in percentage it is 3.97. Okay, so normally it will be in an alphabetical order. So what we have to do is uh, we have to sort it in an descending order. Highest percentage change first till lowest. Now what we'll be doing is just go back to our logic. Our logic says that if market opens up, it will continue to go up. So here what we are going to do is we are going to select those stocks which have had a highest percentage gain on that particular day in that particular time, and we are going to buy those stocks. Okay, but are we going to buy all these stocks? No, we are not going to buy all these stocks. We are going to buy selected stocks, and we are going to buy stocks on the basis of a logic. The logic is if open of that particular stock and low of that particular stock is same, then we will buy that stock. I'll just repeat. Open and low is same. We are going to buy that stock. What is the logic behind this? If open and low is same, that means that bulls are very strong in that particular stock. Why bulls are strong? Because bulls have not allowed bears. Bulls are those people who want market to go up. They are called as bulls, and bears are those who want market to go down. So if open, say for example, market opened, suppose stock opened at 506 and low was 506. That means bears could not push the market by even 5 points on that particular day. So this stock is considered as, you can say, strong bullish stock. And a strong bullish stock will have a uh, sorry, high probability of going up. Yes or no? So that is the logic. See, I'm explaining you how this strategy is formed. It is not just randomly. There is always a logic involved in this. Okay. So what we are going to do, we have to find those stocks. We have to find those stocks whose open and low is same, and we are going to buy those stocks which have these characteristics. So how do you find such stocks whose open and low is same? So basically you'll have to go here open and this is low. So in this case it is not same. Then you go to next stock, open and low is not same. But like you cannot do this manually for 200 stocks. It will take like more than 30 minutes. So we can use a formula here. Okay, we can make use of a formula here, which will in like 5 minutes we'll be able to find out those stocks whose open and low is same. There are other information available here, volume, value, etc. That is not important for us, so we will hide it quickly. Change is also not important for us. Only percentage change is important. So I will show how you can shortlist those stocks. So what you have to do is basically you can use a formula here. So I'll delete this so that I can show you from scratch. So formula is you can use if formula. If, okay, what is the logical test? If open, so I've selected this cell which contains information about open is equal to low. So open and low should be same. Okay. If that is the case, it will ask what we want. So we want, okay, we want to shortlist that stock. Okay, shortlist. Otherwise, nothing. Okay, we don't want. Now here there is nothing because open and low is not same. So we can just copy this formula till the last row and you will get this. Okay, so we have got this Tata consumer. Okay, so you can see open and low. Can you see that they are same? That's why it's shortlisted. Then Bosch, open and low is same. That's why it is shortlisted. So this simple Excel formula will help you to a great extent to shortlist the stocks. Okay. So after shortlisting the stocks, since we don't need other stocks, we will just filter them according to the shortlisting criteria. Now see, we have these many stocks. You can just see there are 12 stocks which obey our rule. What is the rule? Open and low is same. But are we going to trade all the 12? You can if you wish, but there is no need to do that. Okay, you can trade maybe top 5 stocks or top 10 stocks for that matter. For this strategy, I have taken top 5 stocks. So what I'll be doing, I'll hide other stocks which we don't want to trade. So now we come to these 5 stocks: Tata Consumer, Bosch, Tata Communication, SRF, and Dixon. These are the 5 stocks which are top 5. You can type top 5 gainers which follow our entry criteria. Open and low is same, and they are bullish. So we are going to shortlist those stocks. So this is how you shortlist the stocks for buying. So we are going to buy these stocks. Now it is not enough to just come to a conclusion that we'll buy these stocks. How many stocks will you buy? So like Tata Consumer 786, how many stocks will you buy? 10, 20, 30? This Bosch Limited is 16,000 stock, 16,300. This is per share it is trading. So how many shares will you buy? You cannot just buy 10 shares of each and every stock because every stock price is different. So how will you come to this logic? How many shares to buy? How many shares to buy? This is an extremely important question to answer. If you calculate this incorrectly, you will blow your account within few days. Because just imagine Bosch Limited, you buy 100 quantities. Instead of buying 10, your losses will extrapolate. So that is the question whose answer needs to be found out. How many shares to buy? Now, let me give you a very simple technique of answering this question. How many shares to buy will depend upon how much risk you want to take in that particular stock. Okay. So your quantities to buy will depend upon how much risk you want to take in that particular stock. So that's why we have this column P. Okay, I'll be explaining one column at a time and I'll be highlighting that as soon as I finish so that you'll be able to follow me along. Okay, so I'll highlight with sky blue color so that you are focused on one column at a time. So talking about how many quantities to buy, I will decide on the basis of risk that I am going to take. So here I have taken 300 rupee per company. Okay, so I don't want to risk more than 300 rupee in any stock in case I lose, right? So that 300, 500 or 1000 depends upon you, how much risk you want to take. So typically here, if you add everything, the total risk becomes 1500. You can see sum is 1500. Now just imagine you have 10,000 capital. So for 10,000 capital, will you take risk of 1500 on a specific day? So like 1500 will be 15%. That is not allowed. Okay, so here if my total risk is 1500, so I must have at least 50,000 or maybe 80,000 in my account to take that entire risk of 1500. So your risk depends like that. If you want, you can take 100 or 500 rupees risk. That depends completely upon you. So here for your understanding, I have taken 300 as an example. Now stop loss level. Now what do we mean by stop loss level? Stop loss is basically we are going to buy, but in case market turns against us, we we are not going to hope and have patience till the end of the day to turn market on our side, because it may never happen. You buy the stock and suppose it starts falling 10%, 15%, you will lose a huge amount. So there will you will have to decide a level at which you will have to exit. So the logical level at which you have to exit in this strategy is below the low of that particular day. So in this case, Tata Consumer low was 766.25. Now, if that low is broken, I mean my whole logic goes for a toss. So as soon as that low is broken, I don't want to remain in that stock. I will exit. So that is how I decided the stop loss level. So I'll highlight it with red so that you can understand. So this is the stop loss level. Here also you can see 16,009.20. So I've just used a formula minus 0.05 to find out the stop loss level. If market comes at this level, I'm going to exit. I'm not going to wait. Getting this? Now after this, these two things are over. After this, entry is nothing but entry point. Now as soon as you make the analysis, before 9:30 you have to enter in the market. You have to buy specific quantities in the market. Now entry point I have found out at 9:30 in the morning. This is today's 9:25 in the morning. This is today's values of those particular stocks at 9:25. So this is the entry point. Okay. Now total stop loss points that I am going to take is 7.75. How did I come to 7.75? See, if I enter at this point and if I exit at this point, what is the difference between 773.95 and 766.2? Answer is 7.75. The simple formula I've used here, entry minus stop loss. So basically, I'm taking 7.75 rupees per share in Tata Consumers. In Bosch, I'm taking risk of 104.85 because my stop loss is very far. This stock is very big. That's why. In case of Tata Communications, there are 15.25 points loss I'm taking. So these are the stop loss points that I have decided. After that comes important, that is quantity. Now this will give you answer to the question, how many quantities will you buy? I have in this P column risk. So 300-point risk I am going to take. And on each stock, 7.75 I am going to lose in Tata Communication. So if I don't want to lose more than 300, if I take loss of 7.75 per share, how many quantities should I buy? So the formula is simple. Formula is risk divided by stop loss points. In this case, answer is 39. So when we talk about 39, if I buy at 39 and if I lose 7.75 per share, what is the answer that I'm getting? 302.25. So basically it will not be exact 300. So anything around plus or minus 300 is okay. So this is the logic behind finding out the quantities in the market. So basically you are adjusting your quantities in such a way that you don't lose more than 300 rupee on that particular stock. So this is the quantity, answer to how you calculate the quantities in the strategy. Now at 9:30, what you have to do, you have to buy the stocks according to this particular quantity that I've just mentioned. And what you have to do is at the same time place the stop loss for this order. Okay, so you buy 39 quantities at 773.95 and place stop loss at 766.2. If your stop loss is hit, you'll lose 300 rupees in that particular stock. Okay. Now after you do at 9:30, what you have to do? You just have to close the terminal. Don't do anything till 3 p.m. Why you don't do anything? Because you cannot do anything. Market will fluctuate according to its own logic. If stop loss is hit, let it hit. If it goes up, you will make money. And at 3 p.m. dot, okay, at 3 p.m. dot, you have to open the market and you have to close all the positions that you have at 3 p.m. So there will be two scenarios. Either Out of these five, some of the stop losses are hit. If they are hit, then position is closed, and some stop losses are not hit. In that case, the position will remain open. So in that case, you will exit them. So this column that I have taken is, at 2 p.m. I have taken these rates for your information, so that we save our time. So what is the information that we have got is Tata Consumer at 2 p.m. was 787. So now we bought it at 773.95, 787. Suppose we exited, okay? Then how much profit would you make? We would make 13.05 points. How? Entry, sorry, exit 787 minus entry at 773.95. So this is how you calculate the profit on each trade. So you can see Tata Consumer, we made profit of 13.05 per share. In Bosch, we made 195 points. Tata Communication, we lost 4 points. SRF, we gained 7.5. Dixon, we gained 10. So out of 5, we lost in one and gained in other. So if we do this, how much money will we be making? So I'll just highlight this since this is over. If we exit it like this, how much money will we be making on today's trade? You can just see here. This is the profit and loss. How did I calculate? Quantities multiplied by profit. So 39 quantities I bought. I made 13.05 on each trade. So 505 is the profit, 558 profit, 83 loss, 155 profit, 115 profit. So overall P and L that we have is 1205. So like today, like we made 1205 on this particular strategy. Now we will calculate the trade value. Okay, since 1250 has no meaning unless until we calculate how much money we put in, to enter the trade. So how will you calculate the trade value? Simple. Entry level at which we entered multiplied by number of quantities. That will give us how much value stocks we bought. Okay, so this is the entry multiplied by quantity. Sorry, there is some mistake in the formula. Yes. So 29,959, okay, is what we had invested in Tata Consume, and we'll just copy the formula and get these values. And if we do grand total of these, we will get that 1,84,261 is what we invested today to put this trade. And if you can just do rough ROI, this divided by this, and you just convert into percentage. So almost 0.68 percentage return on investment that we have earned today, provided that we don't use any leverage, or okay, we don't use any margin money, assuming that you have 1,84,261 in your demat account. It will fluctuate. Okay, someday you will be investing 1 lakh, someday you will be investing maybe 50,000, depending upon how many quantities you are buying, what is the stop loss, etc. But this is the more or less the logic behind this strategy. So I'll quickly repeat the things for you since the beginning, whatever I have mentioned regarding the strategy. First thing that we did is at 9:25 a.m. we went to this link and we found out what is the change in Nifty. Mention that, note that it is positive or negative. But, and then what we have to do is meetings are meeting. Now we have to click Nifty 200, okay, and we have to download the CSV file. That's an Excel file. Third thing that we did is sort it in descending order or ascending order. Like if Nifty is positive, then descending order we did highest to lowest, and if it would have been negative, then it would have been in ascending order. So top 5 losers will have to find out if market is negative. Fourth step that we did is we have to shortlist the top 5 stocks whose open is equal to low. Okay, that we did. I gave you the formula of doing that. If formula you can use. In case if it is negative, then what will be the formula? Formula will be open is equal to high. Okay, because that's where market open negative. Step 5, this is very crucial aspect of the strategy. You have to work out the quantities. You cannot just buy any number of quantities for that matter, because if you do that, see what would have happened. If you would have, just let me show you. If you would have, in case of Bosch, we bought 3 quantities instead of 3. Just imagine you had bought 30 quantities. If you had bought 30 quantities, then your risk would have been 3000 rupees on Bosch Limited. Now 3000 on capital of 1,40,000 is, in one stock, is huge amount, okay, to lose in a day. So that we don't want. Therefore, this fifth step is very important. We have to work out quantities in such a way that we don't lose beyond a specific point. So we have to work on quantities to buy and stop loss levels on the basis of risk. And lastly, we have to cover the open position at 3 p.m. So at 3 p.m., whatever it is, profit or loss, whatever it is, we have to cover it without fail, because at 3:30 market will close. Okay, so this is the complete strategy for you. Now let's take another minute poll. Umang, you can just let me know what are the answers of students. Which strategy is better for you? Okay, strategy one, wherein annual return is 40% and maximum drawdown. Drawdown is nothing but fall in the capital from its peak. If your capital is 1 lakh and if you lose 20,000, so that means you lost 20%. Okay, so that is nothing but a drawdown, or you can say just loss. So which strategy according to you is better? Strategy one, wherein return is 40%, drawdown is 20%. Strategy two, where return is 30% and drawdown is 10%. Suman, can I just know, like, which strategy, for which strategy students have inclination, one or two?
Students are inclined toward the strategy, second strategy.
Okay, thank you. So yeah, so you may have your own answer, strategy one or strategy two. Okay, some of you may say strategy one because your annual return is 40%, so you are earning 40%, and in strategy two you are earning 30%, and drawdown in case of one is 20%, in case of two is 10%. So see, try to understand. In strategy one, you are earning 40% and you are losing 20%. So ultimately, you are earning 20%. But in strategy two, you are earning 30% and losing 10%. Ultimately, you are earning 20%. In both the strategies, net gain is 20%. But just imagine, in strategy one, your risk is high. Your risk of losing money is 20%. Whereas in strategy two, your risk is only 10%. So although both the strategies are earning 20% for me, in strategy two, I have a lesser risk. I will follow this strategy two in long run, uh, as compared to strategy one, because my losses are less. So when losses are less, you will tend to follow that strategy. Yes or no? So with this, let me take you to the last section. An extremely important section of the strategy is backtesting of the strategy. Backtested data I'm going to show you. So this is a very famous quote: "In God we trust, all others must bring data." Sir, you have told a very good strategy to us. Thank you. We earned 1,300 rupees today. But tell us, in last 5 years, if we had done that, how much money would we have made? If it is profitable, then there is, it makes some sense to trade that strategy. So now I'm going to show you some back testing statistics. Now back testing is nothing but, if you had used this strategy in past, say, n years, how much money would you have made? So if this strategy makes money in last 5 years, there is a high probability that it will make money in future also. So some statistics I'm going to share you in 5 minutes, so that you will understand and appreciate how the things happen as far as statistics are concerned. So I took this 5 years period. Backtesting you can do in software. There are many softwares available for us. There are many vendors which can do it for you, and you can also do it manually. So that is not scope of today's workshop. I'll just show you the backtested statistics of the strategy. So initial capital we started with 1 lakh rupee. In 2016 we started with 1 lakh, and the ending capital we had was 6,66,877. So that means we earned 5,66,877 in these 5 years. So if you just calculate the a rough percentage that we made on investment is 566.88%. Now you will say this is very impressive. So 566, almost 5 times we multiplied our capital in 5 years. So that's very good statistics that we have. But that is not enough. You have to explore, dig into more data and statistics. So if you talk about annualized return in this case is 37.82%. So that means this is compounded annual growth rate. So every year we earn 37.82% return on investment. That is the meaning of this. So total trades that we made was 4,142. That's a large number of trades that we have backtested. Okay, of these winners were almost 60%, for 59.49%. Like out of 100 trades, 60 were profitable. This is the meaning of winners of 59.49%. Now comes more interesting numbers. That is consecutive winners. So like they were 14 is the number. 14 means there were 14 days in this 5 years backtested data wherein you made money consistently. Okay, there was no losing day in these 14 days. So that is the consecutive winners that 14 is what it means. Losers are 40.51. Of course, losers will be 100 minus winners. So 40.51 percentage of your trades were in losses. So like out of 100 days, 40 days you lost money. Okay, and that is where you have to accept one fact that in market you cannot make money every day. Okay, so even if it is 90% accuracy, that means 10% trades will be losers. Okay, so there will be losers in the market, and we have to first plan for the losses and then for the profit. Unless until we protect the capital, we will not be able to make money. And I would like to show you this number, consecutive losers, that is 8. That means there were, in our backtesting, there were 8 days wherein we lost consecutively. Continuous 8 days we made loss. Now this is where the test of your patience come into picture. Just imagine you lose, for 8 days consecutively. What will be your psychology? Okay, you will be tempted to shift to the different trading strategy. You will, it will be very difficult for you to trade on this strategy if you don't backtest it. Okay, since we have backtested and we have found out that yes, I mean there were 8 consecutive days in which we lost the money. In future also it can happen, and if it happens in future you will be okay, because in past it has happened. It is just a matter of time. Okay, losers will go, winners will come, but you have to keep patience and faith and confidence on your strategy, trust on your strategy when things are going bad. If you cannot follow a strategy consistently, it will be extremely difficult for you to make money in long run. Okay, so that is very important. That's why I'm highlighting this. Maximum drawdown. So drawdown is nothing but loss from the peak of your capital. So suppose your capital is 2 lakh rupees, and from 2 lakh it goes down to 1 lakh 80,000. So that means you have lost 20,000. So 20,000 is basically 10% of your capital. So 10% in this case becomes a drawdown. Drawdown is nothing but loss of your capital from its peak. So in the last 5 years, maximum drawdown was 10.77%. This is very low. I mean, you will be able to, survive this drawdown, because 10% is not a big and huge amount for us. Okay, so these are the metrics that you have to see. And last and the most important is this CAR over MDD. CAR is compounded annual rate. So this which I have highlighted, annual return, is nothing but CAR, and maximum drawdown is nothing but your MDD. You just divide CAR. Okay, so this is the CAR, 37.82 divided by 10.77 will give you 3.51. If this number is more than 1, then in long run you will make money if you follow it consistently. If this number is less than 1, you will lose money in long run. Now just imagine if you don't have a strategy and if you don't backtest it, will you come to know your car or MDD? So what you will do, you will blindly follow the strategy whose car or MDD is less than 1, and you will end up losing that money. You will not remain confident to trade on that particular strategy if you don't backtest it and if you don't have data of profitability, and that is what I'm trying to tell you. So 3.51 is very good return over a drawdown, because when you are winning, your annual returns are 38% almost, and when you are losing, it is 10%. So 38 you are gaining, 10 you are losing. So ultimately you are gaining 28%. Yes or no? So these backtesting statistics will give you tremendous amount of confidence when you trade in the market. Okay. Now, I had asked you a few questions in the beginning that a strategy must answer those questions. Let's see that our strategy answers those questions or not. First, what to buy or sell? We have answer. Nifty 200 stocks. Okay. How many days will you hold position intraday? We have answer. Which time frame will you analyze? Like only 10 minutes. First 10 minutes. Of course, we are not analyzing any time frame in this case. We are not using any technical analysis. But yes, like after 10 minutes, we'll be analyzing. How much will you buy or sell? So in this case, I have written that 300 per stock. You can write 500, 1000 depending upon your capital. When to enter the position? Like I said that 9:30 a.m. we will enter the position. When will you get out of the position? Like in losses. In today's case, I mean market opened high, so therefore low of the day is what our stop loss was. But if it opens lower, then it would be higher. When will you get out of the winning position? So at 3 p.m. I said that at 3 p.m. you will be exiting. And how will you buy? Everything at market price. At market price, we'll have to buy. We are not going to wait for the market to come to a specific level. So these are the strategic components that I have. So in next 2 minutes, I'll be just concluding everything for you, and it will be followed by question and answers. So what we learned? We learned that without strategy and backtesting, it's extremely difficult to make consistent money in the market, right? If you want to build a strategy, you need logic first. Without that, you'll not be able to do that. And how can you build logic? Through experience, observations, and listening to experts. Okay. After doing that, you have to, as I said, 30 to 45%. Anything you get between these extremes, it's very good return on investment for intraday trading. And in the end, you must follow your strategy consistently and trust it. Then only you will have chances of making money in the market. So that's it from my side. I'm sure that I was able to give justice to the valuable time all of you have spared. That's it from my side. Umang, you can take this ahead from here.
Thank you so much, Abhijeet. I'm truly astonished at how much knowledge you were able to give us in just 1 hour. And thank you so much for that. But I have a question for you. Um, while this has been a great, the knowledge that you shared would be able to give a great head start to someone who is just starting out in the career in trading. What would you just suggest to someone who is interested in learning even more?
Okay, so the suggestion that I would like to give is devote a lot of time and money in learning and gaining the knowledge before you put in your real money. So, invest a lot of time in learning the things, stock market and its behavior, and then only put real money at stake.
Yeah, absolutely. It's always better to know what you're getting into and to get prior knowledge. And we actually at Internshala Trainings have a training on stock trading made by you, taught by you. On the occasion of What's You Skills Day, we are we want the users to skill up. So for all of you present here, we have a special discount. You can avail a special discount on the trading taught by Mr. Abhijit. All you have to do is click on the link in the description and go to our website and avail the offer. Now, and that's all for this session. Our next session will be starting out in a minute or two. I guess we lost Abhijit, but the next session is starting out in a minute or two. at 3 p.m. But before you go there, I would like to request you to subscribe to this channel, press the bell icon, and you can even join our Telegram community. The link is in the description, and I'll see you at the next session. Bye.